Hi, welcome to More Accounting with Dr. Rob. In this presentation I'll be talking about deferred tax assets and deferred tax liabilities, and in particular I'll be giving you some examples to help you get a feel for how this works. It would be useful if you have already listened to the intuition video, so if you haven't, I suggest you go away and have a listen to that first. Okay, so this is basically what we're going to cover. I've got some slide numbers here, so if you want to jump to one of those, just go straight ahead. Otherwise you're welcome to listen to the whole video. These assumptions I'm not going to read through, so feel free to pause the video and I'll just move on. Okay, so first example we're going to talk about is the standard bad debts example. Now generally with doubtful debts or bad debts, many tax jurisdictions do not allow you to claim a deduction, in other words report an expense for tax purposes, until you actually have quite strong evidence that the debt is in fact bad. So generally that evidence will require some statement from the debtor or their lawyer or their liquidator saying that these guys aren't going to pay. Or alternatively, you've attempted to pursue the debt and you simply haven't been able to recover it. Anyway, you know how it works. So what's the implication for accounting? Well, for accounting, we know that we estimate an allowance when we do some sales. So when we've got accounts receivable sitting there, we want to set against that accounts receivable an allowance for doubtful debts that represents the amount that's not going to be collected. In order to record that allowance, we do an aging, we estimate the allowance, and based on what the amount in the allowance already is and what we want, we record a doubtful debts expense. Now that doubtful debt expense is essentially an estimated expense. It's the result of an estimate. And so in a tax jurisdiction that doesn't allow that, you wouldn't be allowed to do that journal entry. Okay, so if you can't do that journal entry for tax purposes, what are the implications for the balance sheet? Well, if you have a look at the accounting and the tax-based balance sheet, you're going to see that they're different. Let's assume that accounts receivable is 1,000. For the accounting balance sheet, you're going to have an allowance of 50 because you just created it with that journal entry we just did. But you weren't allowed to create the allowance for tax purposes. So if you did a balance sheet using tax rules, the net accounts receivable would be 1,000. Okay, let's follow through the implications of this for second year. But before we do that, let's look at what this tells us in terms of DTA and DTL. We've got a carrying amount and a tax base. The carrying amount is the amount on your accounting balance sheet. The tax base is the amount on your tax-based balance sheet. So we know the carrying amount is less than the tax base. And since we're talking about net accounts receivable, we're talking about an asset. So we've got a carrying amount less than a tax base for an asset. In other words, we've got a deductible temporary difference of 50, and that leads to a deferred tax asset of 30% of 50. That's 15. I'm assuming a 30% tax rate. Okay, now we need to think about why this leads to a deductible temporary difference. So let's follow through into the second year and have a look at what happens if at some stage in future we write off that bad debt. Now for accounting, of course, writing it off involves putting the debit against the allowance. So there's no effect on the income statement. For tax purposes, we weren't allowed to create the allowance previously. So now that we write off the debt, now that we have strong evidence, we debit bad debts expense, and that does appear in our tax profit calculation. So what does that mean in our second year? We've got a tax profit that's less than our accounting profit. It's like having an additional deduction, an additional expense in that year. And in fact, that's what we. So it's because of that effect in the second year that we refer to this temporary difference as a deductible temporary difference. It's like a deduction that's hanging around waiting to happen. Okay, so we know that in the first year we've got a deductible temporary difference of 50, leading to a DTA of 15. By the end of the second year it's gone away. So what are the deferred tax journal entries? Well, of course they're only going to happen in your accounting books. You're going to record a deferred tax asset in the first year. The credit goes against income tax expense, and you're going to reverse that in the second year, so the DTA goes away. Why does it go away? Think about what's happening in the second year. Your income tax expense is bigger than the tax that you're paying because you've got no expense in the second year for accounting. So your accounting profit's bigger. Your tax profit is smaller because you do have an expense. Now let's have a look at revenue received in advance, another DTA example. So firstly, let's assume that revenue received in advance is taxed when received. What this is basically meaning is that the tax rules are going to treat it as income when it's received, even though it may not yet have been earned. So let's have a look at how the accounting and tax differ. For accounting, we've received it in advance, we haven't earned it, so there's a liability which we're going to refer to as unearned revenue. You could call it something else, of course. For tax, however, it's been treated as revenue and appeared as part of tax profit. So let's now have a look at what the two balance sheets would look like. Now, what you're looking at when you're trying to identify a carrying amount and tax base is looking at these entries, you ask the question, what is the balance sheet account affected? Now, ignore cash. That's always going to be the same. It's never going to be different. So what's the balance sheet account affected? The balance sheet account affected is the unearned revenue liability. And it's been affected for accounting to the tune of 90, so we've got a credit there of 90 in unearned revenue liability. Now, what does it look like on a tax-based balance sheet, a balance sheet prepared according to tax rules? Well, it would have a zero balance, because of course in that first entry, we didn't create an unearned revenue. So of course it can't be there. Okay, so let's follow through. The carrying amount is that, 90, the tax base is 0, so we have a deductible temporary difference. Carrying amount is bigger than tax base for a liability of 90, and multiply that by the tax rate, that gives you a DTA of 27. Okay, now let's look at what happens in the second year when this reverses. So what's going to happen in the future year? The revenue is going to be earned. So when the revenue is earned for accounting, you record it as having been earned. So it comes out of unearned revenue and goes into revenue. But for tax, well, there's nothing to do because it's already all been done. Okay, so effectively, if you just step back from this for a second and have a look at what's been going on. In the first year, we didn't have any revenue, but we were taxed as if we did. So what that means is we have paid more tax than we caused. Hence, we've got a DTA, a deferred tax asset. We've paid more tax, it's like a prepayment of tax. Then the second year it goes away. We earn this revenue, yay, but no tax is payable on it that year because it's already been treated as revenue. So even though this revenue causes an expense, it isn't payable to the tax office, instead it wipes out the DTA we created in the first year. So have a look at the journal entries for tax. Well, in the first year, recorded deferred tax asset. In the second year, it goes away. Okay. Now, what if we had no difference? So what if accounting and tax were treating this item the same? So revenue received in advance is taxed when earned. In that case, the two entries would be the same. On the balance sheet, the carrying amount and the tax base would be the same. There'd be no DTA, and the journal entries in the second year would be the same. And of course, there would be no DTA to reverse. I think it's obvious, but it's useful making the comparison. Okay, now let's look at accrued expenses. So what's an accrued expense? Accrued just means built up. So it's an expense that's occurred, but the cash flow hasn't yet happened. So a good example might be provision for annual leave, provision for your employees' annual holiday. So that's going to be an expense when estimated, but for tax reasons, it'll generally just be allowed as a deduction when the cash flows out. So that means you estimate the provision and you make the entry in the first year at the beginning. At the beginning, you're going to make an estimate, so there's an estimated expense leading to a provision for annual leave. For tax, of course, you're not allowed to do estimated expenses, so there's no provision for annual leave. So if you look at the carrying amount and tax base on the balance sheet, the account affected on the balance sheet is the provision for annual leave. We were allowed to create it for accounting, so there's its balance of 120. We weren't allowed to create it for tax. Hence, we've got a deductible temporary difference. Carrying amount is greater than tax base for a liability. That leads to, so the deductible temporary difference is 120, leads to a DTA of 30% of 120, that's 36. What happens in future when you actually pay the annual leave? Well, for accounting, you've already got the expense. So when the cash goes out, you're just crediting the provision. The expense already happened up here. But for tax, you didn't record an expense, so you record the expense now that the cash goes out. Again, what this means is there's no effect in the second year on accounting profit, but there is an effect on tax profit. You've got an extra expense or an extra tax deduction. Hence, it's a deductible temporary difference that's going to go away. And when it does go away, your tax profit is reduced by this annual leave expense, but accounting profit isn't. So tax profit is less than accounting profit. So you're causing more income tax expense by your accounting, but you're not paying it. Instead, it's reducing the DTA. So let's look at the deferred entries. We build it up in the first year, and it goes away in the second. Okay, if we've got an accrued expense and there's no difference, look, I think this is a no-brainer, right? Things are recorded the same in both places, so the carrying amount is equal to the tax base, so there's no DTA, so the journal entry in the second period is the same. So no deferred tax entries again. Let's have a look at a prepayment. So a prepayment, we're going to look at rent, a common prepayment. Rent expense is allowed as a deduction when paid. So when you pay it for accounting, you're going to record an asset called prepaid rent. But if it's allowed as a deduction when paid, that means the tax rules are allowing you to record an expense to reduce profit. So you're paying less tax than you're causing because your tax profit's less than your accounting profit. So you know you're going to have a DTL. Let's look at the balance sheet. What's the account affected? It's this prepaid rent asset. So what's its balance for accounting? It's 10. What's its balance for tax? Well, nothing happened up here, so it's 0. So that basically means that you've got carrying amount bigger than tax base for an asset. That's a taxable temporary difference. Why is it taxable? Well, when the benefits come in the next year, you're going to have an accounting expense to offset them. So your accounting profit will be lower, but you're not going to have any expense for tax. So your tax profit will be higher. So you'll be paying more tax than you cause. So that's why it's a taxable temporary difference. It's something that's going to be taxed in future because there's no expense stopping it from being taxed. And hence you've got a deferred tax liability. You've delayed tax into the future. So first year the DTL goes up, second year it goes down. So the journal entries, the deferred journal entries are pretty straightforward. Okay, what about if there's no difference? Once again, it's a no-brainer. Rent expense is allowed as a deduction when incurred. In that case, accounting and tax are the same in the first period. Carrying amount and tax base are the same. There's no DTL or DTA. And when it reverses, the journal entries are the same, both for accounting and for tax. So there's no deferred entries. Okay, now let's have a look at revaluation. The first one is a new revaluation upwards. Okay, now you know that revaluations generally aren't recorded for tax reporting purposes. If they were, you could buy a pencil, revalue it to $10 million, depreciate it, and never pay tax again. So that's reasonably clear. Assume the asset had a carrying amount of $100 prior to revaluation, and assume its remaining life is 5 years out of 10. So we've already had it for 5 years, so we must have bought it for $200 if we're depreciating it using straight line. Okay, so let's first have a look at accounting. Do the revaluation upwards. Let's say it's a building. So we debit building Z up by 50 and we credit revaluation surplus. For tax, of course, we're not allowed to do a revaluation. So what implication does that have for carrying amount and tax base? Well, if you look at the two balance sheets, on the accounting balance sheet, the building has now gone from 100 to 150. On the tax base balance sheet, of course, it hasn't changed. So we've got a carrying amount bigger than the tax base. It's an asset. So that leads to a taxable temporary difference of 50. Multiplied by the tax rate, that's a DTL of 15. Let's go forward into the second year. What's going to happen in the second year? You're going to do some depreciation. Remember that this asset has already been owned for 5 and there's 5 left. So year 2 is actually the 6th year of the asset's life. So we're depreciating it. When we revalued it to 150. 5 years are left, $30 a year. So that's the accounting depreciation. For tax, we're just depreciating it the way that we were depreciating it previously. So it started out 5 years ago at 200. It's halfway through. It's still depreciating 20 a year. So at the end of the second year, the accounting carrying amount will have gone from 150 to 120 because we've depreciated it down by 30. But for tax, nothing much has changed. 100, but depreciation is still 20, so it's just gone down by the expected 20. So in this case, in the second year, we've still got a taxable temporary difference. Carrying amount is bigger than tax base, but now it's 40. Multiply that by the tax rate, that gives a DTL of 12. If you look at the deferred entries, income tax expense increases by 15 when we record the DTL, and in the next year, part of the DTL moves away. And the rest will move away over the remaining years of depreciation, or as a result of a different profit on sale if you sell it earlier. Okay, now let's have a look at revaluation, but which is a new revaluation downwards. So same general approach, same asset, 10-year life, we're halfway through it. We're going to revalue it downwards from 100 to 60. So we're taking a loss on revaluation of 40 for accounting. Of course, nothing happens for tax. So when we look at the balance sheet and the carrying amount in the tax base at the end of the first year, the net carrying amount of the building for accounting is 60. Of course, for tax, it's still 100. So what's the depreciation going to be? Remember, it's got 5 years left. So accounting depreciation is going to be 60 divided by 5, so that's going to be 12. For tax, it's going to keep going at the 20. Okay, so notice that when we did the revaluation, we had a tax base of 100, carrying amount of 60, so we've got a deductible temporary difference of 40. Why deductible? Because we're going to have more deductions in future than we have expenses for accounting. So that's a deductible temporary difference. That leads to a DTA multiplied by the tax rate, gives you 12. So what happens in the second year? Well, obviously the carrying amount changes by more. It's gone down by 12. The tax base has gone down by 20. So the difference is now 32. That's your deductible temporary difference. And your DTA is now 9.6. So let's have a look at the deferred entries. In the first year, you had to record this DTA springing into existence of 12. In the second year, you had to record some of that going away. So in the first year, you'll debit DTA for 12, credit income tax expense, and you'll credit deferred tax asset, debit income tax expense in the second year when you depreciate.